spend here is a few minutes just talking about the 4 companies that on the oil and gas side that I've brought into the table. Most of my subscribers will know who they are, but just to give a brief rundown for everybody else who's here. So we have with us today D3 Energy, Novus Energy, Ridgeline Energy Services, and NXT Energy. The first 2 are junior oil and gas producers, and the last 2 are oil and gas service companies. So let me talk a little for a second about each one of these companies. So D3 has been my top pick all year, and the reason for that is starting very early in January, they announced in one in January, one in February, 2 discoveries of very shallow, highly productive oil formations. One was the Alberta Bakken that last year was stymied everybody, and all the stocks in that play really took a hit. But this year they were able to figure out the geology, they were able to figure out how to produce that formation, and drill results have been fantastic. You know, most new discoveries like in the Bakken in Canada are 300, 400 barrels a day. These guys are getting 600 to 900 barrels a day IP rate, IP being initial production. And they bought a play last year called the Belly River play up just north of Rocky Mountain House in west central Alberta. And again, the previous operator was lucky to get 200 barrels a day. They figured out how to get 500, 400 to 600 barrels a day. So all of a sudden, this play has become very low risk, very highly productive, hundreds of locations left, and I think the stock is going to see double digits, if not this year, early next year. Novus Energy. So Novus is a poster child for what's happening in the oil and gas sector in the juniors right now. Operationally, you couldn't ask for a better team. 125 wells in a row, no misses. This play is so predictable, which is what the market wants. And yet the valuation on this company is one of the lowest in its peers. It's almost all oil. It is one of the most profitable companies. I love the team. I love the asset. And in fact, now what I'll talk a little bit about this afternoon is there's this whole new thing called water floods in oil and gas, where after you're done drilling, you inject water into the formation and pull out even more oil than ever before. Their play is the great water flood potential. So highly profitable. I just see that at some point in time in the next year, someone is going to take a run at this company because they're doing so well, and the future is like it's set in stone. There's no variability. There's high predictability. So I wanted to get them in front of subscribers right now because I think this story has a lot of room left. It's just starting to get discovered again by the institutions. Ridgeline Energy Services. So these guys have the holy grail of the energy patch right now. What's happened with all the new shale oil revolution and the shale gas revolution, what we've discovered over the last few years is that it takes an enormous amount of water. And water, and I'll be talking about this afternoon, water is the big thing in oil and gas right now. And so everybody is looking for companies that can recycle frack water. They use up to 5 million gallons per well, and there are thousands, if not millions of wells being drilled all over North America right now in the last 2 to 3 years and the next 4 to 5 years that are going to need these types of services, particularly with the drought going on in the southwest U.S. So everybody wants this technology. The regulators want it. The producers want it. They're desperate to be seen as green. So these types of companies are now going to be pulled into the limelight. They don't have to sell this product. The customers are coming to them. They don't need salespeople. They got their name out there. Everybody knows who they are. The product works. They've got their first few customers. They're in cash flow right now. So I see a bright future for this company. Now, Next Energy Solutions is a really interesting company that I've just discovered in the last 2 months. The technology was developed here in Vancouver, of all places, and by a mad scientist who's got a really neat thing going here where what these guys are able to do is reduce seismic costs for producers by 80 to 90%. And when you're doing seismic work, whether it's in oil and gas or even some of the mining guys in uranium particularly are now starting to use seismic, there's very high ground disturbance. You have to go in there and put rods in the ground and put electrical charges in, and you need to get permits. It takes a long time. It's incredibly expensive. What this technology does is allow you to fly high above the ground, and it can identify reservoir traps, which means that you still have to do your seismic, but now you can pinpoint where to do your seismic And when you're talking about having a $50 to $100 million seismic budget a year, which is what a lot of the intermediates and seniors have, and all of a sudden you can save 80 to 90% of that using this technology, you're going to start to see some big revenue growth. In fact, literally today, I'm sure it's a coincidence, but today they announced their largest contract ever, just before market open, $4.5 million with Pemex in Mexico. So even before that, this company was on track to do about $12 million a year this year and be profitable. So this is only going to, give that a bit of a turbo boost. So I'm very grateful that they were able to show up today and tell us about their technology. And like I say, there's no institutional coverage on this company. Nobody knows about this story. It's a very tight stock. There's only about 35 million shares out, and one private equity group in the States owns about 30% of it. So this is truly one of the very few undiscovered stories out there right now, and it's already profitable. So as I said, today, I want you to make the most of your day. So you're going to hear the stories here, decide what interests you, what's motivating you, what's jazzing you, and make sure that at the breaks and at the lunch, you get out there and talk to these teams. That's what they're here to do. They want to talk to you. They want to tell you their story, and just ask as many questions as you can. Here in Vancouver back in 2008, when oil got to $147 a barrel, we had this strange correlation between the price of oil and a liter of gas here in Vancouver. And I'm not even exaggerating a little bit. If oil was $100 a barrel, gas in Vancouver was $1 a liter. If oil was $125 a barrel, gas in Vancouver was $1.25 a liter. And now, I'm sure that was just a fluke, that just the way the taxes and everything worked out. But nowadays, we've got oil at only $95 a barrel, and gas is $100.35 today in Vancouver. So that's a big jump. That's almost like a 50% jump relative to what the price of oil is. And we're seeing this all across Canada. Why is that? Well, I was at a loss to speak about that for a long time, and then recently I bought a refinery stock, which you should all go have a look at, symbols NTI on the New York Stock Exchange. I think it's going to be one of the biggest cash cows of 2013. In fact, at today's crack spreads, it's probably going to pay out close to 40% today. But the point is, in doing all my research for that stock, I kind of got to understand the refinery business a little bit better, and then the light went on. So what's been happening here, the reason we have higher priced gasoline in North America, really, compared to the price of oil versus what we had in the big boom at the top in 2008, is that the refineries in North America make lots of different products. One of them is gasoline for retail drivers. And that's just one of them. It's by far the largest. But what's happening now is that there's a two-tier price system for products in North America. The retail gasoline that you and I put in our car is sold based on WTI, West Texas Intermediate prices. And so that is now pretty steadily about $15 a barrel less than Brent, which is based out of London pricing. So what these refineries are now incentivized to do because of economics is make the smallest amount of gasoline possible and make as much home heating fuel, diesel, jet fuel, kerosene, all these other refined products that they export overseas. Latin America takes a huge amount of home heating oil. Canada takes an unbelievable amount of condensate up from the United States now. Our oil sands producers have increased their imports of U.S. condensate 1,000% in just over a year. So you're looking at the new oil and gas plays down in Texas, like the Eagle Ford Shale, which is number 3 in the world after the Bakken, and even all the new stuff in the Permian Basin. So the Eagle Ford's in southeast Texas, and the Permian is in southwest Texas. Now the Permian is by far the biggest oil play in North America over the last 60, 70 years. But all the new stuff that they're finding there, all the new shale stuff, is, just like the Eagle Ford, 30% natural gas and natural gas liquids. Whereas when up here, or in the Bakken, when you get an oil discovery, or when Marty talks about his oil discovery, it's all oil. But a lot of the new plays have these natural gas and natural gas liquids that they can make into higher-end refined products. So, and they're allowed to export that. In the United States, you're not allowed to export oil, but you are allowed to export oil products. So what you're seeing now is all these refineries moving their processes over, away from retail gasoline, the stuff that you and I put in our car, into all these other areas, because they can sell that at a 15-point plus margin versus what they can sell the retail gasoline at. So refineries generally run on fairly thin margins, and so 15 points for them is huge. And so you've seen a huge increase. All these refiners, what I'm reading in all the research on these refinery stocks, is they're all trying to move their processes over to these value-added products, and they're making money hand over fist. All these refinery stocks right now are at year highs. One of the ones that I followed today, Holly Frontier, announced a special dividend of 50 cents. So that business, refining business, is why we've now got much higher gas prices, almost 50% higher compared to what the price of a barrel of oil is over 4 years ago, because we're now exporting so much more. And this actually gives me a huge comfort level to say that the energy sector is one of the best places to be, because these refined products have kind of a generic name called distillates. And so when you look, I don't have a chart with me here, unfortunately, on distillates, but the global distillates level in the world is trending just below the 5-year bottom. Like, so when you look at all these research pieces, they'll show, okay, here's what the 5-year range is of oil price, gas price, liquids levels, whatever. So when you look at the days of supply, or the amount of supply that there is for global distillates, right now we're underneath the 5-year average, which means that there's a lot of demand for those products. And the number one barometer that I see in the energy patch that says, okay, how do we decide what state the global economy is in? Distillates. Those are the industrial fuels that fuel the world. So if you were to say, what's the one barometer that you should look at to decide on the state of the economy in the world? It's global distillate levels. And right now they are below the 5-year range. Not just below the 5-year average, but like outside of the whole 5-year range at the bottom, which intimates very strong demand, which tells me the world's economy is nowhere near as bad as a lot of the gloom and doom guys say it is. So yes, we're using less gasoline, and you'll read that China's importing less, and that the United States year over year, their usage of retail driving gasoline is less, and that's true. But the true barometer, in my mind, is these global distillate levels. And because they're so low, that is going to support huge refinery runs, lots of production. So even though we're swimming in oil in North America, in fact, we're almost drowning. There's so much of it. But the reality is, so much more is going to export now than ever before. And that's why we're seeing less and less oil being turned into gasoline that goes into our cars. So the supply of that actually isn't near as high as we might think for the amount of oil being produced in North America. So I just kind of came to that conclusion as I was reading all this research on refineries, and really that was kind of what I wanted to share with you a little bit. And now we almost only got 3 minutes left. If we look at a couple quick facts just to run through here for you to think about, to go home with in the next 3 minutes. Everyone keeps asking me, when's gas going to turn? I had a guy unsubscribe today because he says, you don't talk enough about natural gas. I said, that's because there's nothing to talk about. Oil's the place to be. You look at gas, I think we're at the top of the range for gas now here between 260 and 310. There's still 1,000 wells about to come on in the lowest cost shale gas play in North America, the Marcellus back east. So, and there's lots of associated gas, as I said, from the number 2 and number 3 plays in the US, the Eagle Ford and the Permian. Production has not dropped in the States hardly at all, even though we're sitting on all these low gas prices. So with no drop in production whatsoever, I just really have a hard time seeing any breakout in gas for at least another full year. And basically at $3.25, and we're just cresting over $3 right now in the States, you know, you're seeing a lot of switching back and forth between coal and gas, and that's capping prices in a big way. So oil is going to remain the place to be for me. In fact, every time somebody asks me, where's the price of oil going to be, I give them my honest answer, and I'm always 10 to 15 bucks low. And I'm not even trying to be conservative. I go, this is what I think. But of course, before I wasn't really realizing all the refinery information that's going on, plus the geopolitical fear factor. But after every downturn in the last 6 months, or 16 months, sorry, whether it was last year in October, December, this April, then again in June, the oil prices bounced back actually quite a bit better than I would have guessed at any of those times. And so that just tells me there's a strong bid under the price of oil. We have natural declines in the world that are 4 to 5%, which means we got to discover and produce 3 to 4 million barrels a year new just to keep up. And of course, we're getting the global distillate level tells us that the industrialization of Asia is still happening in a big, big way. And even at the bottom of the trough here, with oil at 80 bucks, these companies are making wads of money. The technology is improving so much in terms of how much they're able to get out of the ground at what price. With all of the fracking is literally improving quarter over quarter. It's not a year over year difference improvement in economics. It's literally quarter over quarter. We haven't hit the limits yet of what's possible. They keep finding new ways to get more and more oil and gas out of the ground cheaper and cheaper. So what do I look for in an oil stock? When I'm looking for my portfolio and for subscribers, a couple of things I want to find. Obviously, you want to have a team that's built and sold a company before, same as the mining side. That's so important. I love to find something that's had a big discovery and they've got a big large land package around it. You're going to hear that in a minute with Marty's company. I find 50 to 80 million shares out the sweet spot. It's got enough leverage to make the stock go higher with discovery, but it's not, and it also has enough liquidity that the institutions are willing to play. So that's kind of important to me. Low debt to cash flow. And the recycle ratio is the profit per barrel over the cost per barrel. So if you're making 40 bucks a barrel and it costs you 20 bucks to get it out of the ground, that's 2 to 1. That's the recycle ratio. That's what you want to see. So I'm looking for 2.5 or better. And that's all I've got time for.